Welcome to StockOdds, Odds and Ends podcast. I'm Dave Singh here with Rob Friesen. We're trying to get our bearings on the week ahead and look at StockOdds data to help us do that. Hey, Rob, how's everything this evening?
Good, thank you. Yourself?
I just had a nice, relaxing, warm day down here, so I'm ready to get
where'd
back to
you
trading.
head off to?
Had a nice lunch in Palm Springs.
Just drive over there for lunch, eh? Sounds nice. Sounds good. Sounds like a plan.
When I grow up, I want my lifestyle. So.
All right. Well, just be careful on consuming so much oil. You're just contributing to the problems in society. You know what I'm saying? Okay.
Yeah.
You know, I mean, when those Teslas pass you, they miss. You know, what do you think, huh? What are you thinking?
Well, no. We passed the Tesla charging station. They were full, right? So people are waiting to charge their Teslas. There was a line there.
That's ridiculous. You know, we got to get to the point where there's solar panels all over the car. The whole car should just be sucking in solar. You know, forget this charging station stuff, right?
But I've never seen that before, where there was like a gas line, but an electric charging station line. There were Teslas in a row, waiting for a slot at a superchargers, and that was something I'd never seen before. So that's a sign of the times as well.
Yeah. Well, what if there's like a call to action where you gotta move away from the coast as quickly as possible. You have 30 minutes to leave, and then all these people are trying to charge their cars. Go faster walking, I guess. All right, well, let's get down to business here, okay?
So we had kind of a week. The past week we had a strong Monday, and then the rest of the week kind of a sell-off. There was FOMC news. Interest rates have been keeping up. Pressure on technology. And then we're approaching mid-month seasonality. So we're kind of this weird time frame right now. Yeah. So given that, what do you see?
It started to even out a little bit more in the week in terms of the sectors, but it was really highly pronounced there for a couple of those days where it was like just, you know, healthcare and oil and you know, like it was really concentrated in terms of the green sectors versus the red sectors, right? It seemed to even out a little bit more towards the end of the week, right?
Yeah.
So this week is a shortened week, right? So Friday is a holiday. You get a long weekend, and it'll be nice. Get some rest. That means that things are kind of compressed a little bit, right? So we have the big thing I think this week for me is the bank earnings. Wednesday morning before the market, we have J.P. Morgan. And then on Thursday before the market, we have Wells Fargo, Goldman Sachs, Morgan Stanley, and Citi. And then we also have the CPI, which is really big deal on Tuesday, and PPI on Wednesday. Now, the thing about the CPI on Tuesday is that last time we had it, we saw 7.9% in indication of inflation there, and then this one they're expecting 8.4. I mean, so real inflation is running much higher, but you know, these are just by the book here. And so those are the big things for this week. So anything can happen. Normally before long weekends, you know, the market like Thursday could have like a positive tone, but the problem was how's it going to play out with these bank earnings? And after we have the, you know, CPI on Tuesday and PPI on Wednesday. So it's, you know, it's not a shoe-in terms of like all quiet on the Western Front and, you know, we can just kind of build all the way into the long weekend. I don't know. It's going to be interesting what happens. And we got China, you know, really dropping right now. Apparently there are bottom fishers standing by to pick up some of this stuff, but you know, there's still a lot of concerns with China, so that could be a bit of drag on things. We have the Treasury, you know, 10 years rising again. Now the thing with these banks is. Sorry, go ahead. What? I can't hear you.
It seems like it's rising every day. It's up to like 2.75 now. So every day we're just ratcheting up the 10-year note.
Just kind of slow grind up. Factoring in all this big talk about, you know, half half a point hike, over and over again, maybe.
Yeah.
So, I mean, people are screaming, you got to do something about these prices. And they keep on rising. And the thing about it is, we get a lot of our products from China, and they've got prices rising, factory prices are rising because of the oil implication, because of now lockdowns, and you already have the supply chain problem still not completely healed, right? So this is, we're still in for increased inflation. And so consumers start to scream, and the way to knock it down is what Volcker did in 80, 81, right? Crank up those interest rates, just crank them right up. It'll slow things down.
Yeah, at some point it will crack. I mean, you cannot you can't have prices go up forever, and you can't have interest rates go up this sharply and not affect companies as well. So it will work if they keep increasing. But
so tell me about some of the groups this week. We've got mid-month seasonality starting on Wednesday. So what do you see for some of the groups, just so we can get prepared?
Yeah. So on the screen I did, mid-month seasonality starts on the 9th and 10th business day of the month. And this week it's going to be Wednesday and Thursday because Friday we're closed. But the sectors in terms of ETFs that are expected to do better during this time are energy, like XOP, just consumer discretionary, XLY, industrials, XLE, QQQ. So it's a little bit of a risk on overtone for the mid-month. And then things that are weaker are gold, silver, real estate, IYR, XLRE. So that just shows that there's a little bit more risk on for that mid-month seasonality. And some of the symbols verify that too. FANG and the oils, Teladoc, Twitter, Shopify, there's more high beta tech stocks, Amazon for the long side. And on the short side, gold, SPG, Philip Morris, or MOPM, HCA. So more defensive things are on the short side. So a little bit risk on, and then particularly things like IWM. The small caps are expected to underperform the large caps. The spider's not expected to do much mid-month seasonality, basically flat. Minus 0.03% is what we're expecting on the spider. So small caps underperforming, the NASDAQ outperforming the spider, consumer discretionary outperforming strongly, energy outperforming the spider, utilities, industrials greatly outperforming, and things like financials underperforming, basic materials, consumer staples underperforming, and real estate really underperforming the spider in mid-month seasonality. So those are the big themes I think that we can expect going into the week. And again, we see this 10-year ratchet up 2.7, 2.75. That's going to put pressure on the tech stocks. And crude, it's down a little bit. And you have this backdrop of continuous supply being added right from the petroleum reserve. So you have this tension, put more supply on the market, but then there's a Ukraine situation, and we'll see there.
Yeah,
so it's a tricky week, I think.
There's still a lot of buyers for the Russian oil out there, so it's not like none of it's getting out, right? So, so I imagine that's taking some pressure
and
off
your
too.
Observation too. You said that's supportive.
Yeah. Well, that should be bullish overall, but it had notched down. We talked about it last time. It had ratcheted down. The backwardation wasn't as pronounced. I think it could be that the next couple of days are the pullback for oil. I know that West Texas is down in around 95, 96, and we got Brent just went under 100 or is bouncing around the 100 mark there. It could be that these next couple of days pull back, and then we might see oil ratchet back up for the long weekend, though, right? So, I mean, there's implications of greater consumer demand for a long weekend, right? So that might play into it a little bit for West Texas crude. But just in general, I mean, long weekends pose more geopolitical risk sometimes.
Mm-hmm.
And especially if they're meaningful, religious holidays to some degree too, that can also, be a vehicle I've seen in the past for some incidences geopolitically. So anyway, let's just fasten our seatbelts and be prepared. But like I could see the Monday, Tuesday being the down days for oil, and then possibly, Wednesday, depending on how the numbers go on Tuesday for CPI and then PPI, we might see it ratchet back up for the long weekend. What else do we got on the docket here? The VIX is at around 2360, so we're still elevated. It does seem that it pulled back to a low trough, and now we have the opportunity to sort of build back up on the VIX a bit. Let me run through the futures where we're at right now. So we've got the Dow Jones futures down 0.38% at the moment. S&P futures down 0.57. So it seems to be a little bit defensive going into Monday, with the Dow Jones performing a little bit better than the SPY. And the NASDAQ 100 is minus 0.80 right now. Recall that Dave said that it's on Wednesday that the NASDAQ 100 could outperform both the Dow and the Russell and the SPY as well, S&P 500. So the next 2 days, again, could also be weaker for the NASDAQ 100. Russell is down 0.55 right now. And the Nikkei, what is it? That's down 0.70 right now.
We've got Bitcoin down about 2%, so that's a risk-off signal as well.
Yeah, that plays into the technology stocks a lot too, right? We've seen that correlation there. Now, before we go here, let's just take a look at what the dollar's doing. So we've seen some increase in some of the commodity-based countries' currencies. And that's starting to pull back a little bit now. Well, I'm going to put it on the daily here for a second. So what are we seeing here? Yeah, so Australia's come off the peak, which happened on, looks like around April 4th or 5th or whatever it was. That was kind of the peak. And it's pulled back Tuesday through Friday, pulled back. Canadian dollar, same thing. So again, commodity-rich country. Now, the Japanese yen has been continuously pretty much going down since February. It almost seems to be a bit of a carry trade, short the yen and long the US dollar, because their US dollar has been rising. And again, that plays into the interest rate thing. If you're going to raise a country's interest rates, it does support the currency, right? So the U.S. dollar is, the U.S. dollar is doing pretty good still, right? So the rumors of its demise are greatly exaggerated.
So you see this as negative for commodities then? I mean, if the dollar is going to keep strengthening?
Well, yeah, I mean, it should be that way. But we've seen a lot of times where gold was moving with the U.S. dollar, so they were both strong. Oil also. But if it's starting to sort of normalize that way a bit, then yeah, I would think if the U.S. dollar is stronger, commodities should be weaker. Let's just check out what's happening with the foodstuffs. We got oats just powering up, canola powering up, orange juice, corn. So staples are still, and they're also priced in U.S. dollars too. So they are, if the U.S. dollar is rising and they're also rising, then it definitely shows the strength that's there.
And wheat was up 2.5%, so that's some good movement too.
Yeah, it's off of, it came down from its highs. Its highs spiked at the beginning of March and then it's pulled back. But like some of the other staples are continuing to rise. So definitely putting a lot of pressure on emerging markets and underdeveloped nations because, you know, soybean oil, corn, you know, these are all soybean meal, all staples, right? Okay, well that pretty much does it. I would say, judging by how the week went yesterday with such weak technologies and then coming into what we see right now, there's a good chance that we're still a little bit under pressure with techs, and we might still be doing okay with maybe the healthcare has been on a trend up. We've seen consumer staples still holding up okay. What do you think about financials?
I would say it'll be longer than shorter on those, especially with the 10-year continuing to grind up. But
yeah, let's take. I'm going to pop that in for a sec. Hold on. Let's see. Yeah, well, it did hit pretty much, almost hit the lower Bollinger Band on the XLF on the daily, popped up a little bit, and that coincides with what happened. Yeah, we saw a pretty good drop on the TLT.
But there's this tension now. It's like before that, it was 10 years going up and financials were rallying hard along with it. Now there's this fear of recession that's pulling it back. So it's great we have a yield that's going up, but it doesn't really help anyone if we're going to have a recession. So I think it's tapering some of the gains on financials. But
yeah, well, I was reading an article. I was reading an article too on that a lot of the benefits of the stimulus and other things, especially on the consumer side, you know, lending and credit, you know, people need to be able to pay their bills too. So when you take some of that into account, it really notches down the expectations of the banks for this year. So even though we have this interest rates situation, which should be favorable for them, they kind of ran ahead with the expectations, and now that we're into it, judging by all the other factors, it's like kind of blasé. So I'm not like rah financials either. I guess, you know, we'll have to see how the earnings play out Wednesday for JP Morgan, Thursday for the other banks. Let's see what happens. And then we'll get a better read for the week following. So when we do our podcast next week, we should have more information about our prospects in the banks. Okay?
So for the first 2 days, it looks like a little bit risk off to more balanced, and then maybe a little bit more risk on come Wednesday, Thursday, more tech heavy.
Perhaps, yeah. I mean, unless something changes, but I mean, that's the thing with seasonalities is like I take them at face value unless I see something completely macro, you know, driven that opposes it, and then you make an adjustment, you know. Okay.
All right. Good luck.